Good morning, everybody. Welcome back to Schwab Coaching. It's the Tuesday edition of Trader Talk in today's market, and I am your host, Kevin Horner. Thanks for being here, everyone. It is a chilly day here in Denver. Got a little snow overnight. Not as warm as I'd like it to be, but I am pleased nonetheless to have you all joining me today. Let's get down to business. We'll start by saying hi to my friend Connie Hill in the chat. She, of course, will keep an eye on things there, help me out a little bit, as is often the case, or generally the case on Tuesdays. I'm here solo with all of you, providing me an opportunity maybe to highlight some other areas that might be of interest to traders. In our case, maybe looking at our example portfolio today as well. To make some adjustments that may be necessary, maybe even an opportunity for us to place a new trade based on some of the headline news we got going today. So if you're not already doing so, everybody take a moment and follow Connie and me on X. Connie is available at Connie Hill CS, and I am at Kevin Horner CS. We try to post for you there periodically throughout the week. I am a big believer in providing a look at charts that you might not be aware of, even giving updates to charts that I've brought to the table previously, of course. And, this is one of the ways that we try to engage with all of you. It's a good opportunity to get with us outside of these segments. So please do follow us both there, and make sure you know that you can reach out in that manner, post on our commentary and whatnot. And also, you have the opportunity to do that here in the archives on the YouTube channel as well. So don't hesitate to use the comments function in the archives. Those notes come to us directly as well and offer us an opportunity to hear from you. And we utilize what we can from you to continue improving and building these classes. And so today, as we get going, one of the things that we are going to do, like I noted, is look at some of our existing example trades and maybe even place a new example trade within the example portfolio today. This is something a lot of you have been asking for from this segment. So on Tuesdays, maybe we'll be able to get to a little bit more of that. Now, with that in mind, let's get into our disclosure so that we can get to the fun stuff for you all this morning. Remember that our conversations are exclusively for your information and your education, meaning simply we do not make recommendations here. So expressions of opinion are subject to change without notice. Remember that options carry a higher level of risk. They are not appropriate for all investors. You need to be approved on each individual account in which you may like to trade options. You can approve at various levels on an account-to-account basis. Remember, in trading options, we are working here in a paper money version of the Thinkorswim desktop application. And when you sell options in paper money, you will not be assigned early on those scenarios. However, that is a real world example that can happen. You can be assigned on a short option, call, or put at any time, even if your contract is out the money. That is important to remember as it relates to standard options. So just keep that in mind. And remember further, you can always have a conversation about these characteristics of options with a representative. Never hesitate to call in and talk with somebody at Schwab, as we are available for you 24/7. And of course, the last thing I'm going to note is what I often say: technical analysis. We cover it quite frequently here in class, but we do not encourage you to base decisions only on technical analysis. Make sure you're incorporating a multitude of factors. As usual, this is our agenda. We start broadly. We'll hit up the major indices. We're going to look at some of the industry groups, a couple of notes today on some of those industry groups that are kind of intriguing and might offer opportunity, as I've noted. So we'll see how that looks. And then, like I said, get into some individual examples for you all today. So, as usual, we'll take a look at the S&P 500 today. Here we are off very minimally, basically flat off the jump. And we made that new intra-period high on Friday of last week, have had a little weakness yesterday. And I do mean a little. I mean, we haven't sold down a whole lot. But if you were a trader looking at the peak we made on Friday and saying, you know what, if we could just see us trade through that low of Friday, we might have one of those pullbacks that is kind of common in the back and fill movement of an upward trajectory like we've seen here. Well, you've had a little bit of weakness. Now we've simply filled this little gap, and I do mean a little gap, right? The move here from the last week here, this was the third into the fourth. That move has filled. We are now residing at that very short-term level of support. And so we're simply looking at this from that time frame right now, very short run. Now, we have the 20-day down below us, not too far off, in the neighborhood of 6,000, so about 50 to 55 points away, representative of trend support for you short-term traders utilizing that 20-day moving average. But you all know we've violated that 20-day a few different times and have managed to maintain our trend as well. But what I've been monitoring has been this rising, this increasing slope to the S&P 500's move. So here's what I've been kind of keeping an eye on. Here's the upper level of that channel. We tend to lose steam as we get into that upper level, right? And I say lose steam. What I mean is simply let the rally kind of come to fruition, and that largely, often, I should say, leads to that pullback. Well, that's kind of where we are right about now, isn't it? I mean, we pushed into that upper level, and now we just want to see, can we maintain the upward trend utilizing support along the way? So I'm going to draw on a line through here. Whoops, I probably need to change to the line. And let's just capture some of this last big move right here, right? So here we have a way to look at this is a rising wedge into a zone of resistance, and we are nearing an apex, right? Our lines are getting closer and closer together. And so what we're wondering about is, does the 20-day moving average, does the 50-day moving average continue to provide support? Does the upward trend line provide support for us? As you can see, the slope seems to get a little bit steeper each new climb. And what I'm noting back here, and this is also kind of just a reminder of maybe the lack of true momentum in the move, as much as price action is leading us to these highs. We're not getting confirmation from our RSI. Our RSI did push into the 70 or overbought condition with this last high, but we've not really managed to bust through it here at all. Doesn't mean a whole lot, right? It might just mean that we're a little bit lacking in some of the momentum to continue the breakout from here without a pullback, which is absolutely a possibility. We could certainly get a little bit of a retreat, or even that consolidation over time, where maybe we don't give back as much in price and we just kind of meander sideways above that, maybe the 6,000 level. Like I said, 6,000 being coincident with prior peaks and the 20-day moving average. But broadly speaking, there is a number of key zones of support that will be appropriate to monitor depending on your time frame as a trader. So that 20-day, potentially the 50-day. I think a lot of traders are going to just monitor that 50 because over the 50-day, we've seen pretty good consistency here as it relates to the S&P. Now, the concern would be a break of the 50-day, would be a shift in the trend we have been working with, and that could bring weakness. Just how much weakness is always up for debate. Haven't gotten there yet, so I don't want to, start positing ideas that give you reasons for concern up here. What I do want to do, something I've spoken about recently and frequently, which is simply the reminder to always try and think about, if I'm wrong, how will this look? What are the actions the market could take that could lead me to get uncomfortable? And further, what steps will I take to alleviate that discomfort? Will I be a seller on weakness? Will I generate cash before that weakness comes in? Do you like to be properly positioned and then add that money back to the market when you've had a confirmation of a support test? Those are the kind of things that make a lot of sense for traders to consider along the way. One thing that my friend Mike and I discussed yesterday on our segment here was the concept that maybe you've had a great year as a trader or investor due to a lot of these moves. You don't want to be approaching the end of the year and be willy-nilly, so to speak, in your approach to maintaining your profits, right? Just because you've had a good year doesn't mean you should be willing to take more exposure as we near the end of this year. So try and look at it on a year-to-year basis and calculate those returns and decide how much of the profits you've had this year are you really willing to risk in the final 2 to 3 weeks of this year. Remember that the risk factor associated now with the market is more tied to the downside simply because we've had such a fantastic rally and we are trading at or near all-time highs. So just as always, evaluate, know where you stand, know your comfort zone, and then position properly. That's the best encouragement I can give you. Comment there would just be the reminder that we do this segment on Fridays. That is ETF specific. And when we get into that class, that is a non-archived class. So if you are interested in seeing the discussion of the broad market here utilizing ETFs in lieu of indices, make sure you join us live on Friday mornings at market open, 9:30 a.m. Eastern. Okay, so we've got something to watch here on the S&P. What about what's happening with the NASDAQ? Hey, we just had a trade go off. All right, that's not so. Oh, looks like it's a stop order. We'll check that one out, everybody. So, all right, NASDAQ 100, NDX has broken to the upside very similarly to what we've seen from the SPX. Here we've got a little bit of a flag working out. These are new highs. Breakout level here is right at 21,200 approximately. So that becomes a potential zone of short-term support. This is another one of those rallies that we've seen gaining steam and upside, but also kind of pinching together, right? The uptrend line, our support, and then our resistance band pinching together, coming to an apex, giving us at some point a bit of a break here where we may very well see either a break through the uptrend line, which could signal a whole new trajectory and a new trend to the upside. That's a possibility. Sometimes those breaks that get you outside of the upper trend line, however, can be resistance blow-offs, if you will, meaning you make it through a zone and then all of a sudden everybody goes, whoa, that was way too fast. Let's bring this thing back. And that can happen, especially at extended levels like this. So that certainly is of note. What we would feel better about might be, I say we, ultimately what I'm talking about is shorter term traders relying on these 20, 50-day moving averages in here might feel better about the price action, just like I say, meandering sideways, allowing the levels that we have broken and maintained. Maybe, for example, this 21,000 level, that's equal to the 20-day moving average, pretty consistent with our uptrend line here. You know what? We could kind of go sideways and not even make new highs for a period of days and weeks and still would look at this as a bullish uptrend. The subsequent follow through is, are we all the while maintaining our uptrend line, our trajectory, whether that be the line I've drawn, the 20-day moving average, potentially the 50-day moving average. As always, this comes back to your time frame associated with your process, comfort zone, etc. So certainly want to keep that in mind. But again, not a lot to be concerned about as it relates to the NDX when we look at these top 100 stocks in the NASDAQ. But there are tertiary groups within here that have been underperformers. And we're going to look at the semis here in just a moment, and that will highlight maybe one of those underperforming groups within the NASDAQ 100. Okay, so how about that Russell? Today we're off about 0.5%. We thought we might be in the midst of a bounce area, but today, instead, what we're seeing is a break of the 20-day moving average. Now, the extent to which this break has any legs will need to be played out over the coming day here, the remainder of today's action, and potentially a close below the 20-day might be significant. We have, since we broke the zone of resistance back here, the 20-day has provided support, but I'll just zoom in here. And I'll remind you, what does this candle look like? Why is this candle green? Well, we opened below the 20-day on this day and then managed, in fact, our low was 22.84 after opening at 22.95. So 22.95 open, we dropped about 10 points. Then we got the rally, finished green. In fact, this candle is filled in all the way. And what I mean is no tail like you see on this one. No tail at the top. That tells us that we basically finished at the high of the day. Now, the next day, we had another test of the 20 days. So what I'm getting at here is consistency since the breakout, right? That has led to us believing that the new trend should be the 20-day moving average. All of that can change quite easy if today's close is below that 20-day moving average. So I find that to be very pertinent as it relates to the Russell today. Today's price action in and around the 20-day moving average could be very notable for short-term traders here. We are getting a little lift in the yield today. That might be putting some pressure on these small caps. The yield, the look here could just simply be, hey, we've bounced down or pulled back, if you will, to an area here of importance. And I say that because this is a bit of confluence, right? We've got a 50-day moving average in yields crossing the 200-day moving average to the upside. If this were an equity, we would certainly look at this as a potential buy signal. So maybe we are at an inflection point for yields. Interest rate sensitive groups could be looking at this and saying, all right, if yields are going higher, what could be the impact on our group? I want you to put a pin in that because we're going to talk about one of those groups here momentarily that'll kind of maybe open some eyes to some things here. Okay, so there's real brief conversation around the Russell, small caps, potential moves today utilizing yields. Let's take a look at those semis. So here we are. This is where we talked yesterday about the window of time beneath the major support, whether that support is the 200-day moving average in blue or the uptrend line here that I've drawn in red. As I zoom in, it's kind of notable, right? Last week I talked, I think it was Brent Morris who was on with me on Wednesday. We spoke about, hey, look at how this nice little bounce back, right? Look at those small, the semis here bounced nicely off of this very quick low, bounced up 7.5% rather quickly. And yet we have not done anything to fix this chart, have we? We got rejected at that high. That was the highest high we've had since we broke down back here. And yet what have we done? Except to fail at the 50-day, traded very quickly back below the 200, been trying to fight it out here. Are we holding the 20-day? Yes, we are. But that is, in the short run, maybe traders kind of grasping at straws, suggesting that the 20-day has to hold here. It could, absolutely. May need a little bit of time to flatten that 20-day out and provide some short-run support. But you know what? For a lot of traders, this still looks like a broken scenario, broken uptrend, and we have remained below the broken uptrend. Now, we're getting a little long in the tooth here, everybody. That looks to be about 3 solid weeks. So further breaks to the downside could be significant on the semiconductors here. This is where we absolutely need to be a bit cautious in the semiconductor space for time frames consistent with all 3 of those moving averages, everybody. We are below the 50, below the 200, and are at risk for once again being below the 20-day. So, this is a perfectly appropriate question, Chris. Is it time to redraw that lower trend line? We certainly could. Is it going to make you feel better as a trader if I just put it in like this and said, well, that's really the prevailing trend? You might say, yeah, I feel better with that, Kev. That's great. Give me that trend line. Okay. So what if this trend line then breaks? Is that going to be the deciding factor for the long holder of semiconductor positions or shares in that relative vicinity? Maybe, maybe that's the line. But what do we try to do when we find these opportunities? We try to do, when we draw these lines, we try to find as many touch points as we can. That gives us an understanding of the trend. And I think when you look at the downtrend as an example, we had 3 solid rallies that gave everybody the belief that, oh, everything's fine. There's nothing to see here. And all of those rallies were cool until the higher lows were not held. And now that the higher lows have not been held, well, now we are in the midst of basically we as traders need to basically allow the market to tell us that this is right back where it once was. And we haven't gotten that type of signal yet from this particular group, this indice group, right? So at least for now, and at least for traders who are looking at these windows of time consistent with the 20 and the 50, and potentially you longer run traders, you might be a bit defensive in nature here simply because of the time frame under which we've traded below those moving averages. I think that's kind of a heads up. And yeah, you're right, James. Kind of feels like I sound a little grinchy, but I can't get away from a chart that is not giving me, as a trader, confirmatory signals, reasons to be optimistic. You've got to basically suggest that the narrative matters more than the price action at this moment in time. Now, again, it's all about process. So if you've been a trader and a holder of semiconductors in the triangle we've drawn in, I could understand simply using the last 3 weeks as a means of lightening up those positions, right? Reducing your risk simply because it is now far less clear than it has been in recent memory, right? So we just want to utilize that price action as a means of encouraging as equal discipline or defensive action. Put yourself in a spot of comfort, force the price action to dictate when you are then more comfortable. Hopefully that helps you out to get a little more familiar with maybe trend analysis. Again, I'm not suggesting this is over and you need to move on. I'm simply saying we have a lot of questions and we need more time to feel better about it, right? Okay. There's your semis. Let's see here. Let's do, well, with what time frame here? 20. All right. Let's take a quick look at our discretionary, because discretionary continues to push. We've had maybe a little peakish number there yesterday, a nice move to the upside, but a little bit of dark cloud cover. Now, we didn't necessarily move our way down this candle from yesterday nearly as much, but it is a heads up because we did have more volume in the sell than we've had in the rally portion. So the rally's been good. A little bit of a bullish harami engulfed in today's action, engulfed inside of yesterday's entirely to this point. Maybe a little bit of a short-term heads up, but we've been talking about how the speedier moving averages, the 20-day is just too slow. Look at, I mean, the risk factor of using the 20-day is 100-ish points or so to the downside. So the trader in something like this would need to be very comfortable with the trend that's been working. So giving up a lot, like 100 points on a less than 2,000 point position like this, that's a lot to give up to be a seller. And a lot of traders would maybe prefer to use something a little speedier, like that 10-day moving average, perhaps. So, notable and maybe just a little bit more of a pause as we're getting here. It looks like a bull flag. Certainly looks confirmatory as the RSI has gotten into the same overbought conditions, and momentum has been tremendous because not only have we made a new high in price, but we've made a new high in the RSI. So that gives confirmation of the rally and the breakout, and might imply for bulls more upside. But the question, as always, do we need more? Do we get more upside immediately, or do we just get a little consolidation before we get that upside? That's kind of what we're waiting on at the moment. Big move today is in the communications space. Been a bit fantastic year here. One of the easy cheats we could always do. I'm on this daily 1 year, 1 day chart. I'm just going to put this into my settings. I'm going to go to the price axis. I'm going to suggest that show it to me as the percentage instead. And when I do that, now I can get all my details. So this tells me that on the 1 year basis, 1 year, not year to date, mind you. Okay, so this goes back the full 12 months. We're up on this group, specifically communications, up 47.5% over that 1 year window. If we did this, change this time frame to year to date, that'll change our percentages a slight bit. So year to date, 42%. Based on the last trade here in communications. So communications has done exceptionally well for the year. Looks to be breaking out further. Few areas of zones of support in communication. This one stands out to me. Prior peak, now consistent, pretty close to consistent with the 20-day moving average. You can see something like that. For those of you who are long-term viewers of Trader Talk in particular, might be familiar with the Horner rule, which talks about the confirmation of support or continuation of a trend here, everybody. We've had consolidation along the 20-day, did not see more than 2 closes below the 20-day before it was recaptured. And that's the concept that the so-called Horner rule works against. It's just the idea that if we're going to call a breakdown based on price action, what a trader might want to see is 3 consecutive closes below what you deem to be support. So if you've been looking at the 20-day moving average as support along the way, well, here, this day, we basically closed on it. We were below it intraday and closed on it. The next day, we could call this day 1 as a close below the 20-day. Day 2, doji, but closed below the 20-day. Day 3, we closed back above the 20-day, and then we continued higher. We did not close below the 20. So we got 2 days below it, 2 days below it, didn't get to day 3. So some traders would say, hey, we didn't get to day 3. That means I didn't need to lighten my position. I stuck with my position size along the way and was rewarded with new highs. Okay. Now I know that's hindsight. That's what technical analysis is. But as key components go relative to a trader's approach, having those rules of thumb that will give you the decision factor, right? All right, we closed below support 3 days in a row. If day 4 is not immediately back on gear, I need to start lightening my positions. That's kind of a process that some traders might take over. They might utilize in exiting their trades. And again, part of that is management, right? Do I stick with the full position size? Do I sell a little bit? Do I take a little off the table to give me more comfort so that I can stick with the remainder of that trade even longer? These are all concepts that traders need to define for themselves. We as traders are very, very different. So some of you don't like to sell on weakness. Some of you like to use days like today in communications as reasons to sell. As you move to the upside, some traders love to sell into strength. Some would like to stick with it as long as possible until the weakness comes in. And those traders have to be willing to give up these moves to support, right? I mean, if you're saying, I'm going to wait until it breaks the 20-day, well, the difference here is about 5%. Do you want to give up 5% of profits? If the answer is no, well, then maybe you want to be a seller on strength, moving as you go to new highs as opposed to selling on weakness. So again, define your process, know what it is that moves you as the trader. Okay, let's get to some of these stocks in the news. An area that I noted, I told you to put a pin in a little bit earlier, was in relation to yields and home prices is something, home builders is something I've been monitoring here. So I wanted to quickly hit that. So check this out. The home builder index sitting at a neat area of support. I say neat because 200-day moving average, we have basically put ourselves right back to major support. Major in the sense that the 200-day moving average for this broad space has been maintained for some time. In fact, I'm going to add some time to this daily chart. We'll back this up. Here we go. Look at this. What a lovely opportunity. You had a short-term pullback after a wonderful rally. I'll add an extra year. Why not? Go to 3. All right, so here was our real bottom, right? We recaptured, we were below that 200-day for an extended period of time. We recaptured it, rallied beautifully using that 50-day moving average for the majority of that window. That was, let's see, November of 22. Whoops, I want to use a different one here. Yeah, early November of 22 to this peak. We rallied in the home builders. Beautiful. Look at that, 83%. And then we sold that down to the 200 and under the 200, sold down about 20%. So we had a brief bear market here quickly, but we had to find support at that 200-day, and we are right back to the 200-day moving average, which is pretty darn intriguing from that home builder space. Now, let me kick this back so I can eliminate my percentages. Let's go back to just price action. Okay, so now we are at a major area of support, and the question becomes, can we hold it? And of course, if yields are going to continue to rise, many would suggest that is going to put a little bit of difficulty into the home builder space. Bears watching for traders. Today, what I thought was notable as it related to the healthcare, or pardon me, to the home builder space, we had a couple of downgrades out of an analyst known as Keith Bruyette, and Keith Bruyette downgraded Toll Brothers. And let's take a look at this. I'm going to zoom back into the 1-year chart. So we had a breakdown here of what had been working the uptrend pretty well, working against that 50-day moving average. We had some bouts with the 50-day back here, but we're largely holding major support. The downgrade for Toll Brothers is to market perform, previously at outperform, target here now at 164. That's down slightly from the prior target at 168. So the comment here is that heading into 2025, capital markets momentum as well as stabilization of the commercial real estate values position the commercial real estate finance sector for a recovery. And this is an area of note as it relates to both Toll Brothers as well as D.R. Horton. D.R. Horton was the other one that was downgraded, and DHI downgraded to market perform from outperform as well with a reduced price target. Prior number was $200. This is now $183, stating the exact same commentary. So the firm is basically saying that while the office sector continues to undergo a secular correction with values down more than 35%, it's more positive about multifamily builds driven by significant dry powder and prices having declined, as well as better supply and demand outlook. And that's why both D.R. Horton and Toll Brothers could very well see a level of pressure that was maybe not anticipated originally. So when you look at those and think of these as individual builders that are not leaning into the multifamily and commercial real estate areas, that's why the downgrade for these two specifically. Okay, outside of that, let's take a look at one of the big ones that announced overnight, and that was Oracle. The reaction has not been fantastic, but interestingly enough, the headlines here are not terrible. So we had a Piper Sandler, not an upgrade, excuse me, but a price target raise on Oracle from 185 to 210. They are maintaining an overweight rating on the shares after the results. The Bernstein raised the price target on Oracle to 213 from 202. They also maintain an outperform rating. Citigroup raises the target to 194 from 157. Morgan Stanley raises from 145 to 175. So we've had some positive actions here from the standpoint of price target expectations. And again, as is often the case, I'll remind you that analyst price targets, measured move price targets, none of these are guaranteed to be achieved. Certainly just an expectation that the analyst might offer. Now, this is kind of notable because it's an ugly day. We're down 8%, but are we down more than maybe traders are comfortable with? There certainly are some tertiary details here that might suggest patience in the offing. You have an uptrend line kind of drawn through here that you could work against. That might make sense for some traders. But after a significant move, it really becomes difficult to be a buyer on the very first day of the pullback, right? Because you want to see, does the pullback hold, right? Do we hold on to this 170 low that we've made today? Do we fall further? Do we have to find support at the gap ledge, which would be another 20 points? Some traders are going to look today and say, well, day one below the 50-day, I need to see how this finishes the week. And if we close below the 50-day all of the remainder of this week, that might be significant enough to shake out some more traders. It also could be the kind of move that would give bulls the opportunity to say, yeah, as long as we don't go lower from here, they may start positioning new long side shares at this spot, right? So another way to give thought to it, certainly not necessarily the only way, but many traders will want to see a dust settling before being willing to establish trades on something like this. So let's see how that plays out over the coming days. There might be opportunity there. I did have an upgrade today that I wanted to hit on. upgrade was, oh, yeah, Goldman Sachs upgraded Norwegian. The cruise lines have been doing pretty well. We've been monitoring this one a little bit because that 20-day moving average was working so well. And what I've noted is there's been a few bull flags. One of the common themes I'll speak about is how in the midst of uptrends, you'll often see these bull flags resolve bullishly, right? And bull flags frequently beget new bull flags. And that's what was working in here. Now, they got upgraded by Goldman today to buy from neutral, price target at 35, up from 29. Firm expects a 2025 to be solid for the leisure group, with another stellar year for cruises specifically. The analysts like the setup for Norwegian in 2025, saying data pointing to accelerating net purchase intent and significant cost savings that are still to be realized. This should provide upside to estimates, and the stock should begin to narrow the valuation gap that it has with Royal Caribbean, according to the note that the analyst provided. So quickly, we'll look at RCL as well. Yeah, what a great trend there, huh? That 20-day in orange sure looks like a magnet of support, doesn't it, everybody? We've had a number of key tests. How about some 101 level stuff back here? Break of horizontal resistance right here. Throwback to the horizontal resistance, then now support, and the trend thereafter. We talk about this concept all the time because we never know how long will a breakout occur. How long does it need to run before it tests? In this case, it ran for 4 to 5 days, pulled back, found support consistent with the breakout and the new trend line, and that trend line has held since. And if you'd have been a buyer on the test, you'd done pretty well here on Royal Caribbean, right? About 50% nearly over the course of the last 48 bars, so about 4.5 months or so. Not a bad move there in RCL, but again, the Goldman analyst looking at this as maybe a Norwegian able to play a little bit of a catch-up pattern for you here in Norwegian. And so NCLH seemed kind of notable, but again, big candle yesterday, first close below the 20-day all the way back to August. That cannot be ignored, okay? Now, it can possibly be ignored if you get Norwegian right back up above the 20-day today, tomorrow, for example. That's a possibility, but at least in the short run, make note of the fact that we are below the 20-day, and it might need some time to validate new price levels, and that maybe that's the 50-day instead of the 20-day. You'll notice the last low kind of falls in line there as well, right? Right there. All right. And I think that's all I had from the news side of things. An area that I wanted to check on here, let's get to that monitor tab. So positions that need to be addressed. I have a position in Chipotle. So let's see my equity positions here. There's Chipotle. We got a trade that's working. We're up about 30%, 29%. It's a small trade. You know, again, I'm focusing with you all on process more than anything else. We have a position that's working great. Let's look at it in the trend and see what changes need to be implemented, because the first thing that stands out to me is I've got an exit strategy that is way more risk than I am looking for right now, everybody. And why do I say that? Well, if the last trade at 65 and my stop here is at 50, just under 54, I'm now risking about 11 points on this position. I don't have that kind of comfort. Why would I want to risk that type of move against me? That would be nearly a 20%. I'd still be a seller at profit, but shouldn't I consider raising my stop order as a means of trying to capitalize on some of these moves? And my answer to that is absolutely. So we have some ways to go about it, everybody. We are above all three major moving averages here, aren't we? So now the question is, which one of those major moving averages or an area of support becomes the best for a trader? And that obviously is an individual question we all have to ask ourselves. But some might look here at the low of the gap zone, which happened to be, you know, right through the prior high. So we could maybe set it there. You could also consider below the 20-day right here. Some might also say, well, why not just lower it to below the 200, Kev? In which case, back below the 200, I would feel like the trend really has broken and I'd want to be out. And I would just simply say, that's fine. Do the math. Are you good giving up 7? Are you good giving up about 3.5? Which one of these levels is the level that gives you the greatest comfort? That's the one we want to go with. So in our process, we're just going to go to support. Okay. And I'm going to call that the low of the gap. So the low here was 62.67. And some of you are familiar with this process, but we're just going to bring in the average true range here. Remember what is the average true range, everybody? Simply the high to low spread that we have witnessed over the last 14 days. So it's just giving us the high-low spread, inclusive of gaps, over the last 14 trading sessions. That amount is $1.44 right there. Let's round up to $1.45. And so the way that I might do this is I might look at this low that we established at 62.67 and just come below it by $1.45. Now, why am I doing this, everybody? Well, the average true range is by no means going to lock us in to an excellent way of setting these stops. But what it is going to do is work to reduce the potential of getting stopped out on weakness that might not be valid for the stock itself. Remember, we often get moves in these individual stock prices that aren't really tied to the news or the detail of that stock, meaning you can get what we might call sympathetic moves based on stocks in similar groups, based on overall broad market bullishness or broad market weakness. And what we want to avoid is getting stopped out unless the trend for the equity itself is truly broken. And so some traders who have a strict belief that this 62.60 level should hold could certainly put a stop right there. But that is just as the going right to that ledge means that you are increasing your likelihood of being stopped out. Nothing we do is going to guarantee that you won't get stopped out. We're just trying to manipulate that a little bit. Okay. So we go down to instead 61.22. And what some traders might like is that 61.22 is actually approximately, I'm going to draw an approximate line, but it's below the 20-day. Okay. And so that might be a zone that a trader would prefer. So I'm just going to push that trade right up to about 61. That says 61.18. That's good. I could obviously edit and make it very specific here if I want. Go to 22, sure. But just remember, you can click and drag these orders as well. So we're just going to raise my CMG stop up to 61.22. Remember that this is a trigger price. Once it triggers, it becomes a market order. That means my execution is going to be close to the last trade that triggers my stop. Doesn't have to mean that I'm going to exit close to 61.22, and that's because we have gap risk, everybody. Remember, if we closed above 61.22 today and opened below it tomorrow, with a first trade tomorrow below 61.22 triggers our stop. So if we opened at 55, that would trigger our stop and we would sell at market. So we're going to execute on that scenario close to 55, not close to 61.22, unfortunately. But we're going to place this as our effort to raise that stop. Hopefully we can work to capture some of these additional profits in this trade in CMG. And while I had the design on getting a new trade done, we're just not going to have the opportunity today. But don't worry, everybody. You can come back and speak with me on this tomorrow when I am doing tomorrow is breakout patterns. And so on Wednesdays, we do the breakout class. I come to the table with, I've already got a few positions in here. In fact, let's see, there's my breakout. So we're going to look at some of these for tomorrow. Discuss what has occurred and look at ways to manage these individual trades. So come back and join me then. That'll be at 1 p.m. Eastern tomorrow. We'll get into details. We'll place new trades on potential breakouts and potential breakdowns, and then we'll manage some of these existing breakout trades that we're in the midst of as well. There is a survey opportunity. I would absolutely value your feedback, everybody. Take a moment if you don't mind. Click that link. Thank you, Connie. And it'll open in a new browser window. Takes about 60 to 90 seconds. Supply me with your ideas, your thoughts. What is it you like about the segment here on the Monday to Wednesday class? Or what is it you don't like? Maybe there's some things that happen on Tuesdays in particular when I'm solo that you'd like to see done differently. I am always open to your ideas and your thoughts, everybody. So please feel free to share those with us. Follow us on X at Connie Hill CS, at Kevin Horner CS. Make sure you're subscribed to the Schwab YouTube coaching channel. And finally, if you don't mind, hit that thumbs up down below if you thought today's conversation was a good one for you. I would greatly appreciate that as well. So with that, I will wrap it here. Have a fantastic Tuesday, everybody. I look forward to seeing you all again real soon.